So there's a lot of terms when you buy a house and they're going to, and you're like, what does it all mean? Come right back and Cyrus and I will tell you. Hey, Halifax, Brenda K here with the Halifax Home Selling Group and the sweet Miss Frankie laying right beside me as she always is. Cyrus, Habibi, welcome.
Thank you. Thank you for having me on.
So why don't you introduce yourself?
Yeah, Cyrus Habibi with Premier Mortgage. I'm a local mortgage broker here in Nova Scotia.
The best in Nova Scotia. Say that. Okay, so first question is, Cyrus, what's the difference between a mortgage broker and a bank mortgage specialist?
Yeah, for sure. So as a mortgage broker, we have access to many different banks and lenders. So our main goal is and because we can do that, we can get a real unbiased opinion on where the best mortgage is based on the rate, the product, and all that good stuff. So for us, we just have a lot of options and choices. And banks, they only have what they have. They only know what they can offer because it's the only product they have. Mm-hmm. So for us, we know what the banks and lenders had, then we can kind of sit down, look at your situation in a whole and say, hey, you fit best at this bank or lender, and here's why. And then we can work with clients based on that. So it's not just about rate. We just have a lot of options when it comes to mortgage products, solutions, products, and kind of the whole picture, not just one facet of it.
Okay. All right. Which leads me right into my next question there. You had mentioned rates. Not too long ago, I had someone call me. They wanted to buy a house. And of course, I refer them to you. Oh, I already have a mortgage broker and I can't talk to anybody else. Okay. So went to the mortgage broker. I actually called you on this one a few weeks ago.
That's right.
And they say, oh, no, geez, don't. It'll destroy your credit. I've done a credit check. You got to stay here.
Yeah, it's semi-true, but not too much. I mean, it depends on how many times your credit's pulled. So if you go from this bank to this bank to this bank to this broker, apply for a car loan, get a credit card, all these hits on your credit bureaus are inquiries, and it looks like you're credit seeking. What happens is every time that credit gets hit, your score goes down. So that's what you want to be careful of. So if you're working with, I have a lot of people come to me from their bank and they're like, hey, we're at our bank, we're not really happy or whatever it might be. Can you work with us? This is going to be a big impact. And I tell them, I'm like, typically it's fine. It's not going to be an issue because if they're the only ones that pulled their credit and I'm looking at it again, you're going to be fine. Mm-hmm. But if you come to me, go to another broker, go to another bank, and then, we have 4 or 5 people hitting the credit, then it starts becoming an issue.
Then you're going to have. So pre-approval and pre-qualification, like I know myself, and I work so much with you that you confirm pre-approval and I make sure that my clients are pre-approved. And in this market, some agents, when you submit an offer, they want that letter,
of course,
attached because people get excited, overbid, and then can't afford to pay for it. So tell us what the difference is between pre-qualification and pre-approval.
Yeah, I don't like pre-qualification at all. What that is, it's typically like you go to your a website and you punch in your numbers and it tells you what kind of a mortgage you can afford to get. Or you talk to a bank or a broker and you're like, hey, this is how much money I make and these are my debts. And they're like, okay, well, you should be able to get a home around this amount. A pre-approval is a much deeper process. It's pretty much just as close to a full approval as you're going to get without the actual property details. And we take it a step further because we get all the documents on a pre-approval. So the income documents, down payment documents, because once you find a home, you're not scrambling for the documents and we have everything we need. And then we're 100%, as sure as we can get on the file, right? 99.9%. So on a pre-approval, it's us looking at everything, the credit, down payment, income, pretty much underwriting the file, making sure everything's good to go and being sure on what you qualify for. When you flip it over to a pre-qualify, it's just a very surface level, hey, this is how much I make, here's my debts, well, here's what you can get approved for. But you have no idea what that looks like, right?
You can do it online.
Yeah, you can do it online and those are really inaccurate, right? So it's not a good route.
You may not remember, but I remember because there was such a difference and it was the first time it had happened to me, this spread. I had got a call, went to see the lady, and she was shopping for around $450 based on a pre-qualification online. And when I sent her over to you and you actually pre-approved her, she could only afford 200,000.
Yeah, big difference.
Please don't go by what somebody tells you on a computer.
Big
right?
difference.
Go and talk to somebody. So given how they base the amount that they're owed, or sorry, the amount that they can afford to buy based on their salary, I always tell people, ask, and if they're my clients, they're going to ask you, what will the payment be?
Yeah. And we work off of, we want to, on a pre-approval, we're finding out what the maximum is, but that's not really what you want to spend, right? So we also look at the client's entire picture and we say, well, what do you actually want to spend? Down payment, monthly payment, budget, lifestyle, all those things, right? Because somebody might be pre-approved for 700,000, but they're like, I only want to spend 400 to 500 because I still want to be able to travel. I still want to be able to, have the cars or whatever they want to do. But this is, it's important not just to focus on the max pre-approval, but what do you actually want to spend on a monthly basis and on a down payment basis and all that.
Yeah, I have a budget sheet, and it's actually attached to the bottom of this video. And I give it to all my buyers and I say, fill out everything on this. That's your lifestyle. That's what you want to do. And then when feed in what you gave them and add in $200 for heat and add in $200 to $250 for taxes, and then see, where your payment is. You worked with one of my sons and he has a great job, and he had this really, really high number. But again, like you said, he likes to travel. He likes to do different things. There's not a chance he'll buy anywhere near that number. So that's what's really important. Check what works with your budget. So tell us what GDS and TDS means.
Yeah, so these are terms that we use in the mortgage world, which would be your GDS is your gross debt service ratio, and then TDS is your total debt service ratio. So the gross debt service ratio is just your mortgage payment, your property taxes, and we use like a base amount for heat per square foot, but it's basically your heating, your property taxes, and your mortgage divided by your gross income. And that can't be typically more than 39%. There's exceptions here or there. Total debt service is those three things plus any other debts that you have: student loans, car loans, credit cards, personal loans, whatever they might be, liabilities. So that number can't be more than typically 44%. So gross debt service is just anything related to the house. Total debt service is everything with the house plus your personal liabilities.
Okay. What is the difference between a closed mortgage and an open mortgage?
Yeah, a closed mortgage is set into a term. So typically like a 5-year fix is a closed mortgage. An open, and there's penalties to break those mortgages, whether it's fixed or it's variable, you're locked into a term. An open mortgage is like a home equity line of credit where you can pay it off at any time. Or typically some banks do like a 6-month open where it's designed, it's a higher interest rate, but it's designed for you to pay it out with no penalty if you're going to sell the house. So if you come up at the end of your 5-year term, you might put the mortgage into a 6-month open, pay a little bit of higher interest, but sell the home and have no penalty. So an open mortgage is only really designed for a very, very short period of time because the interests are so high, or a home equity line of credit where it's just like a line of credit. A closed mortgage would be pretty much anything else. 5-year variable, 5-year fixed, 3-year fixed, 2-year fixed. Those are all closed mortgages. Yeah.
So where you said the penalties, people will often say to me, Brenda, it's no big deal. It's 3 months worth of interest, but that's not the case.
Not always. Variable is 3 months of interest,
right?
For the most part, always, but sometimes it's different with some banks. You got to be careful. But then fixed mortgages, depending on when you break them, for the most part, they trigger a different sort of penalty, which is called interest rate differential. And these penalties can be massive. And this is why when we talk about fixed versus variable, it's not just a rate, we talk about the penalty as well. Because, we saw a mortgage 6 to 8 months ago, it was about 470 grand. And the penalty was, she was about 2.5 years in. It was about 31,000 to break.
Oh my Lord. I thought I had one at 17,000 I thought was bad.
So we saw another one there. Saw another one last week. It was only 150 grand. The penalty was $5,500. So you have to be really careful with the fixed mortgages. You can port them from house to house, and potentially save yourself the penalty.
If you're going higher
or lower, it doesn't matter. You can still move that mortgage over. Yeah.
I didn't know you could port to go lower.
You can port it, and it depends on the bank's policies, but for the most part, you can port either way. If you port to go higher, they add money to your mortgage and they either blend the interest rates or add a second mortgage. If you go lower, because with mortgages, you can prepay a certain amount of money every year, 15%, 10%, 20%. If you're going from a $500,000 mortgage to a $200,000 mortgage, they will charge you a penalty on that portion of that 300 grand, but you can still decrease as well.
Because what the bank is doing, they've expected this interest from you for 5 years, and now you're taking it away. So
yeah, on a fixed mortgage, it's quite, and every banks and certain lenders calculate this a little bit differently, but it's quite a high penalty, or it can be quite a high penalty for sure.
Yeah.
You can still get 3 months interest penalty in a fixed mortgage, but typically it's in the first 6 months or the last 8-9 months. The way the math works out.
So talking about that, let's jump to variable, and variable can also be open or closed, correct?
Correct. Yeah. So variable can be an open mortgage as well, but typically, again, like a 6-month term. Home equity lines of credits are all variable mortgages. They're prime plus 0.5% or 0.25% or whatever it might be. So you do get some. It is a variable mortgage, and it's open. You can pay it off whenever. But right, you can have an open mortgage as well on a variable.
Okay. All right. Now, when you have that variable mortgage and the interest rates go up, what happens to your payment?
Yeah, so it depends on the kind of variable you're in. For the most part, it's an adjustable payment, which means if your rate goes up or your rate goes down, your payment will fluctuate with that, so that your amortization stays the same throughout the mortgage. It's great, and I prefer that more, but there is also variables which are called like your static payment variables, which means your payment stays the same, but the amount of money going towards interest and principal is what fluctuates. So those are okay, but the problem is if you don't manually adjust the payment yourself, at the end of, if you're on a 25-year mortgage, at the end of your 5-year term, if the rates have gone up and you've never adjusted it, you might find yourself still having 21 or 22 years left. Like you have to be careful on that, right, on that side of it.
And in all reality, like most of us wouldn't go top that up every month. We'd be like, oh, they'll come down again. You know what I mean? Like, I mean, there are people that are diligent, and then there's people like me, let's check the bank and the mortgage and go, oh, I don't want to see that. There are people, that's how I do my budgeting. Yeah. I'm kidding. Right.
Well, for those specific products, we also tell our clients, we're like, hey, if it's a static payment variable, it's not going to change. You were going to pay a fixed rate at 3 point something anyway. Your variable is going to be 2 point something. Just manually set your payment to be somewhere in the middle or close to the fixed rate anyway. And then that way, as the rates go up, your payment's not changing anyway, but you're paying so much money towards the principal for however long that rate's going to be below the fixed rate. And that strategy works really, really well. But we got to be disciplined to actually make the payment change.
Yeah. Here's on our first house that we bought, it was a split entry in Kobe. It was a new home, and it was $80,000, believe it or not, it was $80,000. And the interest rate was 13%.
Right.
On $80,000, and you can put this in today's terms, on $80,000, our payment was like $870. So on $80,000 today, what would be the payment?
Oh, geez. Every 100,000 today is about $450 to $500 a month.
God.
The interest rate being higher, it's about $500 a month. But yeah, I mean, 80,000 would be somewhere around like $400 a month.
Oh my God. Yeah. What does amortization mean?
Yeah, amortization is the period or the amount of time or years or months that the mortgage is amortized over. So amortization would be your 5, 10, or not your 5, 10, you can go 5 or 10, but typically your 25-year mortgage, 25 years is the amortization of the mortgage. So that's how many months or years your mortgage is spread out between. To
get it paid back.
Right.
Those amount of years. Okay. All right. Is there anything, I'm just trying to think if we missed anything. I am going to do a little plug here because this is the home buying guide, the Home Sweet Halifax that I wrote a few years ago, because these terms are in the back, because as you know, when people are buying, especially young buyers, they're excited. There's so many terms to understand.
Sure.
When it comes to financing. So are there any terms that we missed here today? Cyrus?
That's pretty much it. I mean, you have your basic general. We think we've done a good job of kind of going over all those. I think it's really just obviously lean on your banker or your mortgage professional and have them make sure that they explain everything to you, that ask away as many questions as you possibly can. But I think we pretty much covered all both the terms that we get asked anyway.
And here's what I want to leave this off with today, because this drives me crazy. I've been doing this for 15 years, and I ran into another person, and it was actually two people, lender / another agent. I tell people, if your bank or wherever you send them, Cyrus, if they reject you, it's because you can't afford it. Do not go to a lender, because what happened was this lender said to me, hey, Brenda, don't worry, I'll approve everybody right away. And then if the bank says no, we'll put them in with blah, 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 which was at 12%. So the bank will say, you can't afford that. And then they'll get a second mortgage.
Yeah.
When the bank or your lenders tell a person, you cannot afford this house, it's for their own good.
Yeah.
Do you agree?
Yeah, I agree. I mean, there's very rare situations that a private lender makes sense, and it's usually not because of affordability. It's usually because the property needs to be gutted, or you're doing some kind of a custom build or whatever it might be. But for the most part, yeah, I mean, there's a reason why you're not getting approved, and maybe it's credit, and maybe that's maybe.
Well, that's what I'm talking about. I'm talking about when the bank says you didn't make it based on your finances.
Yeah.
That's what I'm talking about. And then and I have seen people go do it and then go get a second mortgage or go to a private lender. Privates
are rough, and I don't do privates unless it's for the home is just not financeable with the bank, because it's once you get them out, it's so hard to get somebody back out of a private if it's income or credit related, right? And privates only want to be in it for 6 to 12 months. So it's a tough, it's got to be positioned properly for sure.
Yeah. I mean, if you have a bank that, or the lenders won't finance you because of the home, like say you're a flipper, and you have to wear a hazmat suit in, and the bank goes, I'm not touching those a 10-foot pole. That's kind of like the story that I would say with private lenders.
Of course.
Because you're right. Get in there, fix it, flip it, pay them back.
Yeah.
And you're only making the payments. I don't know. Do they charge just interest during it, or do they charge like an actual mortgage payment?
Depends on the private lender, but the ones that we work with typically just do interest only. So they'll charge you, a set percentage per month for 6 months or 12 months until the project's done.
Okay. All right. Well, Cyrus, thank you so much for being here today. And thank all of you out there that watch every week. If you find value in my videos and even if you just find me entertaining, I'm here every Thursday. All we talk about is anything and all things related to real estate on this channel. I'm Brenda K. Sweet Miss Frankie's right beside me. New video to watch in the corner. I'll see you next week. Cheers.